A producer slides a life insurance application across the table. The applicant signs their name, the pen lifts, and the ink dries. For most people, this creates an immediate sense of relief. They assume the paperwork is done and their family's financial future is secure. But legally, an application is nothing more than a formal request to do business. The insurance company has not agreed to anything, and the family is still completely exposed to the financial devastation of a sudden death. A signature carries no legal weight to bind an insurer until money changes hands. If the applicant leaves the table without paying, a waiting period begins where they are strictly unprotected. The information gathered on that paperwork is how the insurer evaluates the risk. For the exam, know that the applicant's medical answers are treated as representations, statements the applicant believes to be true to the best of their knowledge, rather than absolute guaranteed warranties. However, if an applicant intentionally omits a serious medical condition, that is concealment. Failing to disclose a material fact gives the insurer the right to destroy the validity of the contract entirely. This branching timeline shows the critical choice the applicant faces at the end of the meeting. On the top branch, the applicant pays the initial premium up front and receives a conditional receipt. With a conditional receipt, coverage can become effective immediately on the date of the application or medical exam, but only if the insurer later determines the applicant was actually insurable under their standard rules. For our scenario, we will track the bottom branch. The applicant decides to keep their checkbook close today, meaning they leave the meeting with zero coverage. By delaying the initial payment, the applicant has unknowingly deferred all risk transfer. The financial burden remains on their own shoulders until an uncertain date in the future. The paperwork now moves from the kitchen table to the insurance company's home office, landing on the desk of an underwriter. The underwriter is not a salesperson. Their primary function is entirely analytical. They strictly evaluate the data to classify the mortality risk of the proposed insured. They scrutinize the applicant's age, their listed hobbies, and financial condition. But the two variables that carry the most weight in determining risk are the applicant's detailed medical history and whether they work in a hazardous occupation. The underwriter serves as the absolute gatekeeper. Their assessment dictates whether the company will issue the coverage, rate it at a higher premium, or decline the application entirely. To verify the health representations made on the application, the underwriter relies on a centralized industry tool, the Medical Information Bureau, or MIB. Look at this network graphic. The underwriter takes the application data and actively cross-references it against the MIB database, hunting for hidden medical histories or material misrepresentations. In our case study, the investigation comes back clean. The representations are accurate, the underwriter approves the risk, and the home office prints a physical policy. The underwriting process is complete, but a major trap remains. Because the applicant chose not to pay the initial premium back at the kitchen table, this newly printed policy is completely inactive. Underwriting approval is simply theoretical permission to insure a life. Without prior payment, it does not legally trigger the coverage. The physical document is mailed from the home office back to the local producer to complete the final phase, policy delivery. Insurance rules demand that this physical handover must occur while the proposed insured is still alive and remains insurable. Think about the days spent waiting for the mail to arrive. Crossing a busy intersection or driving to work, the applicant is completely exposed, carrying a 100% of their own mortality risk. This is a brutal but common exam scenario. If the applicant dies before the producer physically delivers the policy and collects the first premium, the coverage was never in force. The family gets exactly $0. The logic here is strict. A life insurance contract cannot be illegally finalized with a deceased person unless they made a financial commitment to lock in the terms while they were still alive. Fortunately, our applicant survives the waiting period. The producer arrives at their door, policy in hand, ready to finalize the transaction. Because payment was delayed in Phase 1, the producer's first required task is to finally collect the initial premium check. But that delay triggers one additional piece of paperwork. The producer must also collect a signed statement of good health. This statement forces the applicant to legally verify that they haven't suffered a heart attack, been diagnosed with a disease, or experienced any significant change in their health since the day they first applied. Policy delivered, first premium paid, good health confirmed. Only when these three elements combine does the risk legally transfer from the individual to the insurance company. This matrix breaks down the exact chronology you need to know for the exam. Phase 1 is the application, where you deal with the applicant's representations and the danger of concealment. Phase 2 is underwriting, where the insurer actively classifies the risk and cross-references medical data using the MIB. Phase 3 is delivery. If no money was paid up front, coverage only begins when the policy is delivered, the premium is paid, and a statement of good health is signed.